Welcome back, traders. So let's get started. Now let's start with the basics of price behavior in the market from the market structure perspective. Price movement comprises three primary sub-movements: impulse, corrective, and continuation. Each of these sub-movements is already composed of internal candlestick formations. Now let's get into the details of each one. Impulse movements are characterized by strong, directional price moves in the prevailing trend. During an impulse, the price advances decisively, often forming significant bullish or bearish trends. This phase is typically fueled by strong market sentiment and a dominant force, either buyers or sellers. For example, consider a bullish series of candles as illustrated. We see that the price has formed a series of minor candlestick-based impulse and corrective movements, driving upward until it reaches a swing high. It's crucial to view these bullish internal structures as a unified bullish impulse leg. The rationale behind this is that the price hasn't taken out or effectively swept the liquidity of any previous minor and internal lows at this point. Nevertheless, considering the candlestick perspective, this internal move is identified as our impulse move. Subsequently, we have a valid pullback, as the price has broken and closed below the latest bullish candle, marking a red bearish candle known as a minor correction. Additionally, we see another impulsive move termed as the minor continuation. It's clear that price has followed similar patterns until it reaches the swing high and forms a deep correction in this example. Now let's move on to the corrective movement. Corrective movement in essence is a counter-trend or retracement phase that temporarily opposes the main price direction. Therefore, from the market structure perspective, in the bullish scenario, a corrective movement occurs when the price breaks below the internal pullback or internal low, or when the price effectively sweeps its liquidity with a candle shadow. In this case, we see a correction represented by these three red candles, indicating that the price has broken out and swept the liquidity of the previous pullback's lowest point. Subsequently, we see that the price has pushed to the upside and eventually has broken out the latest swing high. Hence, we consider that as a continuation movement. In a parallel scenario occurring in the second candle series, once again, we see that the price has created a series of minor candlestick-based impulses and corrective movements toward the upside until it entered into a temporary pause, retraced back down with these three red candles. Since the price has not broken the lowest point of any internal pullback or internal lows, or it has not swept the liquidity below them in this sequence, we cannot consider it as a valid corrective movement either. So we should consider this price action scenario as a single impulsive movement without a correction. These concepts are applicable to bearish markets as well. It's important to note that these principles can be applied across various time frames and any price action-based chart. Please make sure that you watch the video attentively until the end. In the second section of the video, we will explore various inducement types, price actions associated with inducements that you might encounter in the market. Now, let's proceed to the next topic and discuss how to identify a valid inducement in terms of candlestick patterns. We'll explore the criteria and rules that need to be considered for this analysis.